So you're your own boss here in Vancouver, and you're dreaming of owning your own home. You've probably figured out the struggle is real. Well, today we are going to cut right through all that confusion. We're going to give you the exact roadmap you need to make it happen.
I mean, it's the ultimate dream, right? To take all that success you've built with your business and turn it into the security and pride of owning your own place. But as you've likely discovered, the path from successful entrepreneur to homeowner isn't exactly a straight line.
You know what you're doing. You've built a successful business. You manage your cash flow. You're a pro. And then you walk into a bank and the traditional mortgage system just kind of looks at you funny. It can really feel like it just doesn't get it, especially right here in Vancouver.
And that's exactly what this is all about. This isn't a question of if you can get a mortgage, it's about how you get one. We're going to lay out the precise strategy you need to follow. So let's dive in. What is it that makes this journey so different, so much more complicated when you work for yourself? Let's break down what I call the entrepreneur's dilemma. First things first, I want you to know you are in very, very good company. More than 13% of the entire Canadian workforce is self-employed. We're talking 2.7 million people. So this isn't some tiny niche problem. It's a huge part of our economy facing the exact same hurdles. You are definitely not alone in this.
And here's hurdle number one, and it's a big one, especially in Vancouver, the price tag. With the average home costing well over $1 million, the amount you're going to need to borrow is huge, and that just puts your application under an even bigger microscope.
This really gets to the heart of it. Lenders, they're used to a very simple story, one that's told by a T4 pay stub. It's easy, it's predictable. As an entrepreneur, your story is more complex. You have to present them with something different. Think of it like a business case for your own financial stability.
And this right here, this is the fundamental conflict. It's the core of the dilemma. On one hand, you're running a smart, tax-efficient business. You claim all your legitimate deductions to lower your taxable income. That's just good business. But on the other hand, that very same tax return tells a lender a story of lower income. See the problem?
Okay, so how do you solve that puzzle? How do you bridge that gap between your business reality and your tax return story? Well, you do it by building a powerful, convincing financial story. Let's look at the toolkit you're going to need.
I want you to think of this as your personal pitch deck to a lender. First, your tax history. That's non-negotiable. 2 to 3 years of NOAs, but that's just the start. You've also got to show the real health of your business with things like profit and loss statements. Then you prove it's a real legit operation with your business license or incorporation papers. And finally, you show them the money, proof of your down payment. Seriously, getting all this organized early is a total game changer.
All right, once you've got your story polished and ready, you need to find the right audience for it. Because you know what? Not all lenders are created equal. Let's break down the 3 main types you'll encounter.
This table lays it all out pretty clearly. First, you have your A lenders. Think of these as the big banks. They're going to give you the absolute best rates, but they demand that high declared income on your tax returns and great credit. Then you've got B lenders. Now these guys are more flexible. They understand the entrepreneur's dilemma, but you'll pay for that flexibility with a slightly higher rate. And finally, private lenders. These are often a short-term solution for really unique situations, but they come with the highest costs. Knowing where you fit in is absolutely key.
And this right here is why a really good mortgage broker who specializes in this stuff can be invaluable. They don't just find you a rate. A great one acts like a temporary chief financial officer for your application. They analyze your whole situation and then package your story perfectly for the lender who is most likely to say yes. Okay, so you've got your story, you've identified your potential partners. Now we've got to get into the nitty-gritty. Let's talk about the specific rules of the game that you absolutely need to master. When it comes to proving your income, you essentially have 2 paths you can go down. The traditional path is simple. It relies entirely on your tax returns. But the stated income path, now this was basically designed for entrepreneurs. It allows you to state what your income truly is based on your business's real performance. But, and it's a big but, there are trade-offs. You'll need a larger down payment and you're going to pay more for something called mortgage default insurance.
So what even is this insurance? Well, to be clear, it's protection for the lender, not for you. But it's the magic key that unlocks mortgages for people with smaller down payments. The cost, which they call a premium, isn't some big fee you pay up front. It just gets rolled into your total mortgage amount and you pay it off bit by bit over time.
Now this highlights a really critical decision point. Just look at that top row. If you have a 10% down payment, the stated income premium is almost double the traditional one. This is the price you pay for that income flexibility we were talking about. It's not right or wrong, it's just a strategic choice you have to make.
At the end of the day, this is the big question, isn't it? After all this, what's the number? Well, it all comes down to one major hurdle that every single borrower in Canada, self-employed or not, has to face.
And that hurdle is the mortgage stress test. Here's the kicker. You don't actually get qualified at the interest rate you're offered. You have to qualify at a much higher stress test rate. It's the government's way of making sure you can handle future rate hikes. And just look at the impact. On a $100,000 income, it can slash your borrowing power by well over $100,000. This is the single biggest reason you might get pre-approved for way less than you think you can afford.
So how do they actually calculate that stress test? They use these things called debt service ratios. It sounds complicated, but it's not. GDS is just your housing costs versus your income. TDS is all your debts, car loans, credit cards, everything versus your income. The main takeaway here? The A lenders, they want to see that less than 44% of your income is going toward paying off debt, including your new mortgage.
Okay, we've covered a lot. We've talked about the dilemma, the documents, the different lenders, and the rules of the game. So now, let's put it all together into an actionable game plan for you.
Here it is, your 4-point plan. Number 1, build your history. Lenders love to see at least 2 solid years. Number 2, organize your story. Get all those financial documents in a neat little folder before you even think about looking at houses. Number 3, know your path. Really think about whether the traditional or stated income route makes more sense for you. And number 4, and this is a big one, manage your debts. Paying down a high-interest car loan or credit card can directly increase how much you can borrow for a home.
And let's just end on this thought. You've already done the hardest part. You built a successful business from absolutely nothing. The same focus, the same strategy, the same determination you used to do that, that's all you need to apply to this process.
The path is there. The system can be navigated, and you now have the roadmap. So the only real question left is, are you ready to take that first step?